SVOL has delivered an annual yield of 16%, and that huge monthly income has allowed it to produce a total return that has kept pace with the S&P 500. Now, all that sounds great, so what's the catch? The catch is that if the VIX spikes, the fund is at risk of significant losses, and on August 5th, 2024, the VIX spiked higher than any time since the 2020 pandemic. So today we'll look at why SVOL survived its worst nightmare and how its competitors held up. And spoiler alert, it got pretty ugly. SVOL's dividends are reasonably consistent. In recent months, 30 cents per share per month. The yield is typically around 16%. It's a little higher at the moment as I record this in early August 2024 because on August 5th, the market had a mini freakout. But I expect the yield to return back to around 16%. Also, it's important to note that most of the returns for this fund come from the distributions. I don't expect price appreciation, but with a 16% yield, you don't really need price appreciation. These distribution and yield charts are from Snowball, but I mostly use Snowball to keep track of my current and future income. I can visually rank my portfolio by current yield, I can see yield on cost, and know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth because now they have to pay for everything. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, or in this case, 16%. And if you'd like to see a copy of my portfolio, it's available via Armchair Insider. There's a link in the description, and it's free. Conceptually, I think of SVOL as being like an insurance company. SVOL generates high, consistent income when market volatility is low. In other words, when things are normal. When things are calm, insurance companies make a ton of cash. It's only when there's a disaster like a huge hurricane that it sucks to be in the insurance business. SVOL makes most of its income by taking a short position on VIX futures. Shorting means they profit when the VIX goes down. The VIX is higher when the market is fearful, so in simple terms, high VIX means high fear, which is bad for SVOL. Low VIX means low fear, which is good for SVOL. Here are the mechanics of how it actually generates income. We all know the basic trading concept of buy low and sell high. SVOL is shorting futures, so it does this in reverse order. It sells high, then buys low. This chart shows the average price of VIX futures, so this trend is the norm, at least most of the time. Each slot along the bottom represents the price of a futures contract for each successive month in the future. Investors are buying these VIX futures for protection. They go up in value when the VIX goes up. In other words, when the market is panicking. The trend is clear. Buying protection further out is more expensive. SVOL takes the other side of the trade. They're the seller. As an example, they could sell futures here at a high price, then 1 month later, when that contract that was 2 months out is now only 1 month out, it's worth less. At that point, SVOL buys the contract back at a lower price. The difference between the selling price and the buying price is SVOL's income that it distributes to investors. So let's see what happened when volatility went through the roof. Over the past 3 months, the VIX has been trading at around 12 or 13, which is fairly typical. On August 5th, the VIX shot up to 65 and then came back down to close at just over 38. For context, that's the highest spike since peak fear in early 2020 when a global shutdown was on the horizon. Even though the VIX didn't close as high as 65 on August 5th, it did reach that crazy high level during the day. So this wasn't a little bump, it was a true test. If we continue the insurance metaphor, this was a devastating hurricane as far as volatility is concerned. Let's take a look at how this massive VIX spike affected 3 ETFs that short the VIX. SVXY fell just over 21% on August 5th in 1 day. If you think that's a gut punch, save a thought for SVIX shareholders. They lost almost 40% on that day. SVOL was down almost 6%, and for context, the S&P 500 was down almost 3%. So on the worst imaginable day for inverse VIX ETFs, there's a lot of daylight between the three funds. And if we zoom out to the past month, we can clearly see the difference in total return between the three. And that's good news for SVOL shareholders. These charts raised two important questions for me. Number one, why would anybody want to buy the other two ETFs that short the VIX? And more importantly, why didn't SVOL crash like the other two? The answer to the first question is, if the VIX doesn't crash, shorting the VIX is very profitable. Look at SVXY and SVIX versus the S&P 500. They were crushing it here. The problem is you'd have to time the market to hang on to those profits. In other words, if you buy it just before a VIX spike, it gets ugly. That's just too much risk for me. As for why SVOL didn't collapse like the other two, the short answer is it takes less risk, but let's break that down. SVXY's exposure to shorting the VIX with futures is 50%. SVIX's exposure is 100%. SVOL's exposure ranges from 20 to 30%, so let's call it an average of 25%, which is far less than the other two. Two of these ETFs have hedges to reduce their risk. SVXY does not. SVIX has one hedge, call options, and without those, the loss would have been far worse than 40%. SVOL's risk management contains a few elements. The primary one, like SVIX, is to buy calls on the VIX. Secondly, they use put options written on the S&P 500. If the S&P 500 falls far enough, those put options increase in value, even if they don't reach their strike price. Thirdly, SVOL trades futures contracts further out on the curve than the typical inverse VIX trade, which targets the second month. That means less profit, but also less risk. Also worth noting that SVOL distributes income, whereas SVXY and SVIX do not distribute income. Before we discuss the timing of an SVOL purchase, I want to mention a few resources that are helpful if you're interested in this ETF. First of all, the majority of SVOL's holdings aren't actually in futures contracts or in options. They're treasuries and ETFs that produce additional income. This analysis on Seeking Alpha by John Bowman is a good overview of recent changes to those holdings. I'll include links in the description to that analysis by John, as well as a free trial and a discount for membership. I use the premium level, which I think is pretty much ideal for most income investors. I'll also include a link to this video I made last October, which explains SVOL's risk and the term structure concept in more detail than I can go into in this video. Speaking of term structure, I'll include two links so that you can check the term structure for yourself when you're watching this. The official page from the CBOE is okay, but it's a bit clunky, so I'll include another website called VIX Central that's much more user-friendly. You just click historical prices, enter a date, click get prices, then click next date to move forward one day at a time. And by the way, the only reason I found this obscure little VIX website is because I read a comment below this article on Seeking Alpha. Now, I actually disagreed with the article, but I still read the comments, and sometimes I learn more from the comments than I do from the articles. There's no perfect price to buy SVOL. If there was, everyone would buy at that price. And the reason is that there are two factors at play at the same time. There's the current value of the VIX and the shape of the VIX Futures Term Structure. If the VIX spot price is falling, it's good for SVOL's price. If the term structure is in backwardation, it's bad for SVOL's ability to generate income. The good news is that the VIX doesn't stay elevated for long, and the term structure doesn't remain in backwardation for long either. The normal state is a VIX ranging from 10 to 20 and a term structure in contango, which means the VIX futures increase in value over time. Once again, these concepts are explained in more detail in this video. Having said all that, if you want a general rule of thumb, an ideal time to buy SVOL would be just after a big VIX spike if you think that the elevated fear in the market is subsiding. So yes, there have been some opportunities in the past week, as I've recorded this, to get SVOL at a better than normal price. Personally, my allocation is already close to my 5% cap for each investment, so I didn't make any major moves this week. This whole exercise has simply reassured me that SVOL shall remain one of my top 10 holdings. Under normal market conditions, SVOL has delivered a yield of about 16%, and when the market suffers a major correction, the price takes a hit, as do most ETFs. If you think there's a lot of really bad news on the horizon, then SVOL probably isn't a good fit for you. I accept that the 16% yield comes with some risk and that the downside for this ETF is far less than it is for its competitors and not that much worse than most other asset classes. Looking at SVOL in isolation, I would withdraw about half of the 16% yield and reinvest the other half to grow my income. In reality, it's part of a portfolio of more than 30 investments, so I don't actually break it down to that level of detail. But as a general rule, the higher the yield, the more I reinvest back into the portfolio. If you want the most up-to-date copy of my portfolio, there's a link in the description. It's called Armchair Insider. To put it simply, SVOL's protective measures are no longer a theory. They've been tested and they worked. SVOL is one of the high-income investments I summarized in this playlist that begins with an overview of my larger investments. That wraps it up for this SVOL update. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.